Welcome to Virtual Wisdom Finance and Accounting Tutorials. My name is Peter and I'll be your host in this particular tutorial. In this tutorial, I want to show you how to prepare an income statement, or what we call a statement of comprehensive income, and it is also called a trading profit and loss account. This is a topic in financial accounting, and this is basically found in the topic on preparation of the financial statements of a sole trader. A sole trade is a business that is run and operated by one person. It's a small business, and the financial statements prepared for this business are only two. That is the statement of financial position and the income statement, or what you are calling the statement of comprehensive income. So at the end of every year, every business must ascertain the net profit or the net loss that is made in that particular period. And to get the net profit or the net loss that is made in a period, that is what brings about the income statement. And to obtain the net profit or the net loss, this is obtained in two stages. One, you have to find the gross profit, or what you call the gross loss. We are going to see how you go about that. And then two, you find the net profit or the net loss for that particular period. Let's start with the gross profit or the gross loss. A gross profit is the difference between the sale proceeds of a particular period and the cost of goods actually sold. So what we are saying here, when you take the sales and then you minus the cost of making those sales, whatever remains is either a profit or a loss. If it is a positive figure, that is, if the sales proceeds are higher than the cost of sales, then whatever the resulting figure is a gross profit. If it is a negative figure, then it is a gross loss. The other thing is a net profit. In a gross profit, we have not taken care of expenses, and after now you take care of the expenses, that is when you get the net profit. So on the gross profit or the gross loss, we normally add the incomes and then we less all the expenses. Then the figure that is obtained, if it is a positive figure, then we'll have made a net profit. If it is a negative figure, then we'll have made a net loss. To understand this, we are going to look at an illustration that is going to help us understand better. But before that, let's look at the format. The format of the income statement, or what you're calling the statement of comprehensive income, or the trading profit and loss account. So you find that a statement of comprehensive income or a trading profit and loss account, it contains two accounts in one account. That is, there is the trading account and there is also the profit and loss account. And that is why it is called a trading profit and loss account, because it combines these two accounts. Or you can also call it the statement of comprehensive income, which it actually combines these two accounts. So how do you prepare that? Like we normally say, in any given account, there must be a heading which indicates the name of the business, the name of the statement which you're preparing. Like in this case, we are preparing a statement of comprehensive income, and the duration. This statement is prepared for the year ended, or for the period ended 31st December 2020. Unlike a balance sheet that is prepared as at a particular date, the statement of comprehensive income is normally prepared for the period, because it covers all the expenses or all the incomes that were incurred and that were received during the entire period. An accounting period, most of the times, accounting periods will run for 1 year. So if an accounting period for a business is starting on 1st of January, then it ends on 31st of December. That 1 year is what we are calling an accounting period, or an accounting year, or if in case a business is preparing its financial statements quarterly or semi-annually, it will still be based on the 1 year values. So when you're preparing a statement of comprehensive income, it has 3 columns. A standard statement will have 3 columns, and the objective of these 3 columns is for you to be able to do adjustments in the figures so that your work is organized. So the first thing to appear in a statement of comprehensive income are the sales. So the sales, we normally record them in the second column here. Why? Because we need to adjust the sales. There is only one item that affects the sales. So if the sales figure is here, there is only one item that can affect the sales, and that is return inwards, or what we call sales returns. This is when you sell goods to customers and then those customers return the goods back to you. There are various reasons why customers might return goods back to you. 1, if the goods are of low quality. 2, if it is not what they ordered for. 3, if the goods were damaged. 4, maybe, or any other reason. So when these goods are returned back to you, it means that you had made the sales, but when they are returned, you have to accept the goods and reduce the amount of sales that you had made, because now you have the goods back. So these returns are going to reduce your value of sales, and that is why you put this figure in bracket, showing that we are subtracting. You less that from the sales that you had made, because these goods have come back. It's like if you had sold you sold a television set, you sold 2 sets at 20,000 each, and then the customer returned one of the sets. It means you will have to return the cash to the customer, so you're going to remain with 20,000 and not 40,000 like before. So that is why we are subtracting from the sales. So when you minus that, so you get your net sales. And now the figure of net sales is what you take to the last column here, and that's why I told you these 3 columns are used for adjustments. So we have adjusted the sales by lessing the returns, and then we get the final figure there. Now after getting the net sales, we normally less the cost of sales. So cost of sales is normally subtracted from the sales, so that we can know whether we have made a gross profit or a gross loss. Cost of sales, this is the cost that is incurred for you to make the sales, and we have several cost of sales. So for you to determine the total cost of sales, you have to determine the cost of the various items that make up the cost of sales. The first item is the cost of the stock that you had at the beginning of that particular period. There is no single time when you can sell everything. Maybe in a shop, for example, you will have some stock belonging to the previous period that were not sold. So when you're opening the month, when you're opening the year, that is the next period, this stock from the previous period will become your opening stock. And the cost of those opening stock, for example, if you are selling calculators, for example, and you remained with 2 calculators last month, so these 2 calculators, the cost of those 2 calculators will be the opening stock cost. This figure is not affected by anything, and that is where we take it to the second column. Then the other cost that you need to add here is the cost of purchases. These are now new stocks. If you are selling calculators, you only have 2 calculators, and you need to have several. You need to have more calculators, so you need to buy more calculators. So when you buy these calculators, the cost of buying, the buying price, that is also a cost. So you add it. You need to include it into the cost of sales. But before that, the purchases are normally affected by 2 items. One is what we call the carriage inwards. Carriage inwards is the cost incurred to bring those items to your place of business. For example, if you're operating in a market in Nakuru town and you buy your calculators from Nairobi, so for these calculators to reach you, you're going to pay for transport. The cost of transport will be shifted to the customer. How? You're going to increase the price of the calculators. So if you bought one calculator at 500 shillings and you incurred 50 shillings to transport the calculator to Nakuru, the cheapest price for you to break even, you have to sell it at 550 shillings for you to recover. And that is why this amount is normally added to the purchases, because this cost is recoverable. You're going to recover it by passing it to the consumer. So this cost of moving the goods to your premises is also added to the purchases. Apart from that, we have what we call returns outwards, just like returns inwards here. Return on purchases, this is when you buy and then you return the goods outwards. You are taking them from your business outwards. You bought, they came in, and then you return them outwards. That is outside your business. The reason why you're returning them, you may have your own reasons. For example, the goods were damaged, the goods is not what you ordered for, and many more reasons. So when you return these goods, the cost of those goods will be reduced from the purchases. Why? Because you'll be refunded. You'll be refunded the amount of money maybe that you had spent on those particular goods. So we need to subtract that, and that's why I've put the figure here in brackets. So when you add the purchases plus the carriage inwards minus the returns outwards, the resulting figure is the figure for net purchases. And now this is what now we are going to add to opening stock. As you can see, we were just adjusting here because these two items only affect the purchases. So we need to adjust here so that we can have the net purchases here, so that they can meet with what? The opening stock. Now they have met with the opening stock. Now when you combine the cost of your opening stock, we said you had 3 calculators from last year. So these 3 calculators, and maybe you have bought 10 calculators, how much will you have in total that you are going to sell during this accounting period? You'll have 3 which were opening stock and the 5 that you have bought. So you have a total of what? 8 calculators to sell. So these 8 calculators, the cost of these 8 is the cost of what you have that you're going to sell during the period, and that's why we are calling it the cost of goods available for sale. We have 8 calculators that we are going to sell. What is the value of these calculators? These calculators is 3 calculators from the opening stock and 5 calculators from the purchases. We have the total of cost of goods available for what? Available for sale. That will be the total there. Then when you end the period, or when you end that year, at the end of the year, maybe you have not sold all the calculators. You had 8, maybe you sell 7 and you remain with 1 calculator. So the cost of that 1 calculator will not be incurred in that year, but it is going to be pushed to the next year, and therefore we are going to subtract the cost of that 1 calculator that you have not sold, and that is the closing stock. So we have a closing stock of 1 calculator, so that this 1 calculator will be an opening stock in the next period. Here we are in the year 2020. So in the year 2021, in January 1st, we are going to have 1 calculator from the year 2020, and that's why we are subtracting here, because this cost of 1 calculator is not incurred in this particular year, but it will be incurred in the next year. So once you subtract that, now you're able to tell during this year how much did we incur, how much cost did we incur in the operations, and therefore the total cost which we have been calculating here, we were looking for the cost of sales, is what now we are getting here, cost of sales. And remember we said cost of sales is subtracted from the net sales. So take it to the last column so that it can meet with what? The net sales, so that you can be able to minus the net sales minus the cost of sales, because we said less cost of sales. So when you minus now the cost of sales, this is what will determine whether we have a gross profit or a gross loss. So if the resulting figure is a positive figure, then we have a gross profit. If it is a negative figure, that's why I've put it in bracket, then it is a gross loss. And after getting that, the section that we have just completed, the section that gives you the gross profit or the gross loss, is what we call the trading account. So here all these represents the trading account. So this is basically the trading account. Then we continue. So this statement continues downwards, but in this case I'll use another page. So downwards there we continue from the gross profit. What do we move to? So from the gross profit we normally add the incomes. Income is what you have earned, the gain that you have earned, whatever you have earned during that particular year. Some of the incomes include, we have something like a discount received. You bought goods and you are given some discounts. You have some tenants who paid rent to you. You had some interest that was paid to you. We had some decrease in provision for bad debts. A provision for bad debts, if you have a feeling that there are some debts that are not likely to be paid, you can provide for them, so that when you are calculating your profit, you don't include them as debtors. You include them as what? You have something that you've provided for them. So if the provision decreases, that is after you have gained some, maybe due to some knowledge that you have gotten that this person is likely to pay, and therefore you reduce the provision, that decrease is normally treated as an income. Later on, we are going to see that in an illustration. So you put in all the values for all the incomes here, then you get the total income. That is what you're calling the gross income, and the gross income is what we are adding to our gross profit. On the other, here we have the gross profit. Here, remember, we are continuing from that particular point. Then after that, you less the expenses. Expenses include carriage outwards. Remember, carriage inwards were added to purchases because we said this cost is recoverable. But how about carriage outwards? Carriage outwards are not recoverable. These are costs like after sale services. A customer has bought a machine and you have decided to transport the machine for them. So that cost, you cannot recover it, and that is why it is an expense to you. Discount allowed is an expense. Postage, we have salaries, we have rent paid, we have insurance, bank charges, and increase in provision for bad debts. Again, put all the figures there, get the total, and that will be the total of your expenses, the total of expenses. And then your gross profit or the gross loss, you are going to add the incomes, you're going to less what? The expenses, and the resulting value here can either be a positive value or a negative value. If it is a positive value here, then that is a net profit. That would be a net profit. To be a net profit. But if it is a negative value, that is a figure in the one that I put in bracket here, it will be a net loss. It will be a net loss. One thing that you need to know, how do you identify the incomes or expenses? Incomes have a normal credit balance and the expenses have a normal debit balance. We are going to see that in an illustration. So this is the format of statement of comprehensive income. So let's now look at an illustration that will help us understand better. So you are told here that the following is a trial balance of Jane business. So you're given a trial balance. We have the debit here and we have the credit here. Remember, this is debit and this is the credit column. Then you're given the items. We have inventory, carriage outwards, etc. Then it continues, salaries, cash at bank, continues all the way to capital, the totals there. Then additional information. Inventory as at 30th September 2012 was valued at shillings 29,460. This figure here is very important. We need to identify what that figure is required. Draw up a statement of comprehensive income for the year ended 30th September 2012 and a statement of financial position as at 30th September 2012. And as you can see, even the question arranges them like that. An income statement comes before a statement of financial position. Why? Because the resulting figure in the income statement is what will be transferred to the statement of financial position. Now, let's go back to the items given here. If you look at here, we have inventory. This inventory is at 1st of October 2011. 1st of October 2011, and we are required to prepare this statement as at 30th September 2012. What does that tell you? That this stock here the stock here is simply what? The opening stock, because it is when the period started. And then when you check on the additional information, this stock here, the inventory here, inventory is the same as stock. The inventory here is for the period 30th, it was there on 30th September 2012. We are preparing our statement on 30th September 2012. So this stock was there when we were preparing the financial statements. And when are we preparing the financial statements? At the end of the period. And therefore, this is what? The closing stock. So let's go straight to preparation of a statement of comprehensive income, or what you're calling the trading profit and loss account. Again, start with the let's go to solution. Start with the title of the business, name of the business, Gen Business, statement of comprehensive income for the year ended. Very important. It's for the entire year, for the year ended September 2012. And we said the first item here to appear is what? Sales. So check the value of sales from the statements given here. So sales is 186,000. So we have the first figure, 186,000, and we said sales is affected by one item, which is return inward. So we need to check whether we have any returns inwards. So do we have any? Yes, we have return inward. So we need to subtract that from the sales. So you minus that to get what? The net sales. That's what is resulting here, the net sales. After minusing 186 minus 2050, you get 183,950. Then on that, we are going to less the cost of sales, which we have to calculate. How do we calculate it? We start with the opening stock, and we have said that the opening stock is a stock at the beginning here, which is 23,680. You take 23,680, which is here. Then you go to purchases, and purchases are affected by two items, carriage inwards and returns outwards. So you have to check for the two items there. So again, we have the purchases here, then we have carriage inwards, then we have carriage inwards of 3,100, and we have returns on purchases, that is returns outwards of 3220. We have that 220 there. So when you go back to the question, so you're going to take the purchases, you add that 100, you less that 220. So whatever is resulting here is your net purchases. And net purchases, we normally add it to the opening stock. So you're going to add this to that, so that you can get what? The cost of goods available for sale. So when you add these two here, this plus this here, and you add the two, remember a line like this in accounts means addition. So when you add that, you're going to get 142,300, which is the total cost of goods that are available for sale. Then after that, we are going to less the closing stock. We minus the closing stock to know the total cost of sales, and we have seen that the closing stock is what? 29,460. So we less 29,460 from that from the figure there. So you don't need these. You didn't need that. So from the total here, you're going to less the cost of the closing stock. Then you get your cost of sales, and cost of sales is subtracted from the net sales. So you're going to take the net sales here, then you minus the cost of sales, which is 112,840. Then whatever is going to remain is either a gross profit or a gross loss. But if you check here, we have the net sales is a larger figure than the cost of sales. So the revenue is more than the cost, and therefore we have a gross profit. We have a positive figure, which is a gross profit. Then on that, we are going to add the incomes. And how do you identify the incomes? You simply check from the items given. To identify incomes are credited. So you check for the items that are credited and are not balance sheet items and are not items in the trading accounts. For example, here we have return outward. Return outward is that is a what? It is in the trading accounts. It's going to affect the trading accounts. Sales trading account, discount received is not in trading account, and it's also not in the balance sheet, and therefore this is one of the incomes, that is an income there. Then you check creditors, that is a balance sheet item. Then we have 3-year loan, which is a liability, balance sheet item. Capital is a balance sheet item. So we only have one income, and that income is the discount received, 3,000. So you add 3,000 there to get the gross income of 74,110, and then you less the expenses. The expenses, we have several. So expenses are normally debited, so you check for those items that are debited and are not balance sheet items and are not items in the trading account. This one, inventory, this is a trading account, that is the opening stock. We have carriage outwards. Carriage outwards is an expense, so therefore this one is one of the items as an expense. We have carriage inwards, that is in the trading accounts. Return inwards, trading accounts. Purchases, trading accounts. You continue like that. We have salaries and wages, that is an expense. Rent is an expense. We have insurance, which is an expense. Motor expenses is an expense. We have office expenses, expense. We have lighting and heating is an expense. General expenses, expense. We have premises. Premises is a non-current asset, therefore not an expense. Motor vehicle is a non-current asset. Fixtures and fittings, non-current assets. Debtors is a current asset. Then we have cash at bank, which is a current asset. Then we have drawings. That one is going to affect the capital. So as you can see, we have identified all the expenses. So you list them down, then you get the total of the expenses. I have the total here. Then these expenses is what I'm going to subtract from the gross income. So gross income minus the expenses. Whatever is going to remain, is it a profit or a loss? Check. If the gross income is larger, if it is more than the total expenses, then we are going to have a net profit. If this figure here is less than the total expenses, you're going to have a net loss. So in this case, 74 is higher, 74,000, and this is 61,000. So we have a positive figure, which is a net profit. So we have a net profit of 1370. So we have a net profit of 1370. So that is the statement of comprehensive income, or what you are calling the trading profit and loss account. And now in this case, once we are done with that, this is now the figure that we are going to carry to the balance sheet. This is what we're going to carry to the balance sheet. And like I showed you here, just slightly back, let me take you back a little. So we said that this section here, this is the trading section. This is a trading section. So that is basically the trading accounts, up to where you get the gross profit. Then we have this section here, incomes minus expenses. Incomes minus expenses is your profit and loss account. So in case you are asked to prepare a profit and loss account, you simply take the incomes minus the expenses. That is all. You get a net profit or a net loss. But if you are asked to get a gross profit, then you need to take the items in the trading accounts. So having done the statement of comprehensive income, let's now prepare the statement of financial position. So the statement of financial position has 3 columns. So we start, of course, with the title. In my other tutorials, you'll find a very comprehensive tutorial on how to prepare a statement of financial position. So in this particular case, I'm just going to mention based on the illustration. So we have the title there. Then we have 3 columns: the costs, accumulated depreciation, and the net book value. Then we have the non-current assets. Non-current assets will come first, and we say that for you to prepare the statement of financial position, you are guided by the bookkeeping equation, and the bookkeeping equation states that assets equals to capital added to liabilities. Assets equals to capital added to liabilities, and assets are divided into 2. We have the non-current assets and we have the current assets. Again, liabilities are divided into 2. We have the non-current liabilities and we have the current liabilities. So we start from this end here. We start with the non-current assets. So in this particular case, we have 3: premises, motor vehicles, and fixtures and fittings. Their costs is 50, 18, and that 500. So we don't have any accumulated depreciation. So get the total cost. This figure is not added with any other, so you can close it. You put 2 lines up and down. Then we have the accumulated depreciation. We don't have any depreciation provided here, so this will be a dash. And then you have the net book value. Net book value is the cost minus the depreciation. So since we have nothing here, it will be 50 minus 0, which is 50,000. 18 minus 0, 18,000, like that. Then you get the total. So we don't need to put a line here, but here you can put a line to show that that is the total. So that's 71,500 minus 0 to be 71,500. Then here we are going to add the current assets, so you leave it open like that. So from here we go to the current assets. Current assets, we have inventory or the stock, and here we use the stock at the time that we are preparing the financial position. When are we preparing? Remember, a statement of financial position shows the position as at what the business have at that particular date. So what is the stock at that particular date? So the stock at the end of the year is the closing stock. That therefore you include the figure that you put here is the closing stock figure. Then debtors, cash at bank, you get the total. You take the total there. Then you combine these two to get your total assets. You get your total asset, which is the figure on this side. We are done with that, the assets. So we move to the other side of the equation. So we move to capital, and capital will fall under the financed by section. So financed by here means that this business is financed by one, capital or equity, whatever is contributed by the owner. And then we have liabilities, whatever the owner has borrowed. Anything that is borrowed is a liability. So we start with the capital. The capital is 100,000, and capital is normally affected by 2 items, only 2 items. One, net profit. The net profit that we got from the statement of comprehensive income is what we add to the capital. If we had a net loss, we would have subtracted it from capital, and then we less the drawings. Drawings is what is taken for personal use. For example, you have a shop, you have visitors, you decide to take bread from the shop and give it to the visitors. You take sugar from the shop to cook tea for the visitors. That sugar, you have not paid for it, so you have used capital belonging to the business. And like you say, a business should be a separate entity from the owner. You don't just pick the capital, you are only allowed to take the profit. So when you add the net profit minus the drawings, you remain with 101,070. Then we move to the second item, which is now the liabilities. We start with the non-current liabilities. Non-current liabilities, we have a 3-year loan. How do you identify them? Non-current liabilities are those loans that are payable in a period of more than 1 year. So you can see here we have a 3-year loan. So this loan is payable in more than 1 year. Therefore, it's a long-term liability or a non-current liability. So it's only one. You don't need to put it here because it's only one. You don't need to adjust. So take it to the last column. Then current liabilities, we have creditors. You put it there. Then get the total. So the total of capital added to liabilities, which is non and current liabilities, you get 144,740. And just like you said, this side of the equation should be the same as this side of the equation. As you can see here, we have 144,740, and here we have 144,740. So those two figures are balancing, and therefore you put a double line. A double line in accounts means balancing figures. It means we have this figure here and we have this figure here. Those two are balancing. Remember, this is one account. It's only that in this particular tutorial I'm using 2 different pages, but it is one account continuous. It's a vertical format of a statement of financial position. So that is how you prepare a statement of comprehensive income and a statement of financial position. I hope this tutorial was useful. This was virtual wisdom finance and accounting tutorials. If you like the content that I'm sharing, kindly don't forget to subscribe to this channel. Click on subscribe so that your subscription can count. I want us to check next time and see a higher number of subscribers than how much we have today. Kindly subscribe. Don't forget to click on the bell icon so that you can be notified anytime there are new videos that I've posted new videos. Like the videos, share with friends, and leave a comment. If you have a question, leave it here. I'm going to respond as soon as possible. Thank you for your time. My name is Peter and I was your host in Virtual Wisdom, Finance and Accounting Tutorials. Bye.